I'm Bob Landaas, president of Landaas Company.
So at some point, of course, we will end the asset purchase program. Subsequent to that, we will follow the guidance that we provided about interest rates.
When you look at Ben Bernanke, year ago May, talked about tapering, reducing bond buying. The bond market got hurt almost overnight. Traders have no experience on tapering. It's never happened before.
Bernanke's testimony riled the markets and led to a sell-off in bonds. But by the time tapering actually began, bonds rallied. That's the kind of year it's been. We've seen concern and uncertainty, but also recovery and prosperity. Since last September, stocks have climbed that wall of worry to reach new heights. October 1st.
In 5 minutes, the government will shut down. This bill does nothing to prevent that. We won't have an operating federal government.
Gentleman's time has expired.
Congress fails to reach a spending agreement. Though the government shuts down, businesses remain open, and earnings continue to grow. October 9th, President Obama's nomination of Janet Yellen to succeed Bernanke at the Federal Reserve suggests the Fed's crucial monetary efforts will continue.
I'm honored and humbled by the faith that you've placed in me.
December 18th, the Fed announces plans to begin tapering in January. Yields on the 10-year Treasury climb, ultimately ending the year above 3%.
Federal Open Market Committee concluded a two-day meeting.
On New Year's Eve, a reason to celebrate. The year ends in low volatility and extraordinary growth. The Nasdaq reaches a 13-year high. The Dow Jones Industrials and S&P 500 both close out 2013 at all-time records. On January 7th, 50 major U.S. reporting sites record record low temperatures. Severe winter weather slows everything, from home sales to manufacturing.
And Joel, I've always been suspicious of anybody that blames weather for financial results. But this past winter actually was pretty accurate. It was miserable. Milwaukee, coldest in 32 years, snowiest in 27 years.
The U.S. GDP drops by 2.1% in the first quarter. The markets freeze in a narrow range. January 31st, the first day of the Chinese New Year. Despite hopes of sweeping away economic ill fortune, the world's second largest economy continues to slow.
Their export numbers came out in February. They were terrible. Their exports fell 18% year over year. That's bad no matter how you try to sugarcoat it.
Emerging markets, dependent on China for 33% of their GDP, also suffer. Troubles in emerging markets, followed by weak manufacturing numbers in the U.S., lead to a steep but brief dip. Just as quickly, the markets are climbing again. Despite turmoil in Ukraine, Afghanistan, and Syria, the U.S. markets show amazing resilience through the month of March. Green shoots of growth shine in the spring sun. By April 1st, the Dow has completed a remarkable recovery, erasing its winter losses. Contrary to expert predictions, bondholders benefit as 10-year Treasury yields continue to drift down, settling at 2.4% by Memorial Day. June 6th marks a significant milestone. The U.S. reports gaining back all of the 8.9 million private sector jobs shed in the Great Recession. And still, inflation remains out of sight.
We've averaged below 2% inflation now for a couple of years, way below the Fed target, but that's what allows interest rates to remain pretty low.
June 18th. Janet Yellen reaffirms interest rates are not expected to rise until 2015, and stocks close at record highs for the 20th time in 2014.
Good afternoon.
China shows signs of turning a corner. June 22nd, the Chinese Purchasing Managers Index indicates expansion for the first time since November. July brings U.S. profit margins worth celebrating.
They're the highest they've ever been. And Joel, that's not unusual. That's borderline rare halfway through a business cycle for margins to stay so high.
A cool Wisconsin July ends with news from international hotspots that sends shivers through the markets. Still, nothing but good news for investors. The S&P climbs above 2,000 and the Nasdaq tops 4,500 for the first time in 14 years. The economy keeps growing. Second quarter GDP shows output increasing at a rate of 4.2%. Underlying fundamentals remain strong.
The market is selling for a fair valuation. Earnings are supposed to grow at above average rate for the next 3 years. And as a result of broad-based participation in the stock market and the fact that we have a fairly accommodative interest rate policy, I'm pretty optimistic for stocks for the foreseeable future.